Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Let's bring in Margie Patel of Allspring Global Investments. She wrote that in 2025, I expect another decent equity year, although not with the total performance that we have seen this year. Admittedly, the market looks rather frothy. I'm pleased to say Margie joins us now. Margie, thanks so much for spending some time with us on this holiday shortened week. What are you seeing in terms of the frothiness? Where is it most prominent?
Well, I think it's not so much in the stock market. I think you can see this manifestation. There's actually a lot of liquidity in the financial markets. You see it in crypto. You certainly see it in real estate. You see it in the explosion of private debt and private equity, which has been a big boost to the financial markets. And it's really kept a lot of the Fed's actions out of the control of the Fed because it's been in the market, not like the banks where things are tightly regulated. But as far as the stock market, I'd say it's reasonably priced for another decent year next year.
Talk a little bit about the interplay between those private assets, whether it's private credit or private equity to a lesser extent, and what that means for money flowing into equities.
Well, I think that the first thing is, if you think we had the Fed make the biggest increase in its history in short-term rates from basically 0 to 5% in 18 months, and yet we didn't have a recession as a result, that tells you that the money flows in the financial system really isn't under the bank's thumb and the Federal Reserve supervision the way it used to be. So you've seen a lot of companies that needed liquidity could actually go to these private markets and get at least terms, period, and also better terms than they could have gotten in the public market. And so I think that's why you could say, well, the PE is high, 19 times, something like that. But really, when you look at the profit growth under that and compare that to where Treasury yields are, it looks rather reasonable to me.
Well, Margie, one of the byproducts of the Fed raising short-term rates, as you mentioned, from 0 to 5%, is that cash looks great here. Yields are relatively high on money markets. Even still, you have $7 trillion sitting in cash right now. It feels like for the past couple years, people have been calling people moving off of the sidelines back more fully into risk markets. Do you see that actually happening when you take a look at all that money market action?
Yes, I think you'll see a lot of towel throwing from the cash equivalent market because if you look at it, if you got a good yield historically in cash this year, say 4 or 5%, but on the other hand, the equity market was up 15 to 25%, depending whether you looked at value names or more growthy names. That's a big disparity for investors, and I think people have been hoping and actually believing that we would have a recession. The recession hasn't come with the Fed at least stable to probably cutting rates. It's very hard to see how we could have a recession in 25. So we're thinking 1.5%, 2.5% economic growth, maybe even surprising on the high side. And I think that's going to draw money out to say, how many years do you want to leave that much of a spread on the table?
Well, Margie, let's say that you have been sitting in cash, you've been over allocated, and now you have the luxury of having a lot of money here to deploy. When you take a look at the relative values of the different asset classes, specifically when it comes to fixed income, to equities, where's the best opportunity right now?
Well, I think it's in equities, even though we've had two terrific years. I think that if we have the economy growing, 2 plus or minus %, maybe on the high side, that should allow corporate profits to be up, say, 10 or 12%, just as they were up this year about 13%, even though we had more modest economic growth. So that says if that's your target on likely return on equities, when you look at fixed income treasuries of, say, 4.5%, if you look at high yield, you're only looking at, say, 6.5 to 7.5%. And because we've had rallies in the fixed income market, those bonds are really trading at a very small discount from par, say around 98 cents on the dollar. So there's not a lot of capital appreciation in the fixed income world. By the same token, defaults have been very low. Mm-hmm. So you haven't been taking much risk when you dip down into below investment grade. So I think that still says the pendulum's over on the equity side where total return should be higher.
Okay, so within equities, do you go with what's been working all along, the defensives, in this case, Mag 7 big tech type names, or do you go and maybe start picking up some of the underperforming sectors in the market, whether it's materials companies or energy companies? Both those groups not moving more than 1% so far this year.
Yes. Well, I think that you really have to stick with the companies that have proven to have profit growth. And a lot of that has been in the tech sector, some industrial sectors that have been tied to the big themes, electrification increases and data centers, I think are going to continue to do well. And even in actually energy, I think that gas-related names are going to continue to do surprisingly well because they'll benefit from the expansion in gas as used to increase our baseload power capacity. But I think a low-growing company, when we've had a decent market, is most likely going to stay low-growing. So it says you have to buy the quality, buy the higher-priced relative stocks because they probably will continue to have strong earnings in 2025.
You know, I look at the VIX, and it spiked up to almost 28 on Wednesday after the Fed decision. Certainly, we saw equities sell off. We saw bonds sell off. It's come right back down, though, now just about above 16.5. Is the Fed going to be the source of volatility in 2025, or is it going to be the incoming White House?
Well, the Fed has been pretty dependable. It's causing a lot of volatility in the marketplace by their actions that haven't really produced positive results. So my money is the less the Fed says, and the more in the background they are, the better. As far as the new administration, there are lots of exciting ideas, lots of frothy talk about what might happen. And we'll have to see how practical and how quickly some of these ideas that look favorable to business can get through. I'd say the big positive is that there's no longer any talk about raising corporate income taxes, which would have been a real depressant on the market had that gone through. I think to have tax rates for corporations where they are even lower will be a positive factor for the stock market continuing to do better next year.
Well, let's talk about the relationship between what we're talking about on the fiscal side and what that could mean for monetary policy. Torsten Slack over at Apollo put out a note of risks in 2025 yesterday, and it was nice because he actually put probabilities next to them. He assigned 40% odds that the Fed raises interest rates in 2025. You aren't seeing that being priced into the market at all, virtually, right now. Do you think that some of the things that we're talking about, tariffs, taxes, if those come to fruition, should we be talking about a potential rate raise next year?
Well, I'm not so sure about the tariff situation, how soon they'd be imposed, what the immediate impact would be on price levels. But I think it is interesting to think historically. You've often seen a second wave of inflation after a first wave looked like things were tamped down. And really, when you look at these other signs in the marketplaces, so there's plenty of liquidity, that says maybe inflation is going to be much harder for the Fed to bring down to its target level of 2%. So I think it's certainly, I'd say 40% sounds fine, that there is that possibility later in 25, the Fed could say this isn't working, we need to raise rates, the economy's doing fine. So I think it's a possibility. But again, that would be if we had, I think, a pretty strong economy. The Fed's always very, very sensitive about looking at unemployment rates and the economy before they act. But a strong economy, I think that's likely.
What does that spell for the back end of the Treasury curve? Scarlett and I were talking just a few minutes ago about how there's been plenty of demand for the short end. And of course, you can see that in money market funds. You can see that in the auctions. The long end of the curve has been a much hairier place to be. What's your expectation in 2025 in terms of duration volatility?
Well, I'm not looking for any big spike up in the long end of the Treasury market because although I think for domestic investors, we tend to want to be shorter in maturity with things like Treasuries or municipals. But I think that globally, there are many investors, international entities that would like that very, very long duration because there aren't a lot of places where a long-term investor can get very, very high quality and long duration. So I don't think that's going to be a problem. The Fed can always change what they issue if it looks like there's pressure on one part of the curve or not. But really the issue is the amount of financing that the Fed has to do because of the very, very large deficits, meaning that you might have a little bit, in my opinion, of, say, excess supply in the Treasury market versus the stock market versus even corporate bond market, high yield market, where there's a relative supply scarcity. I think that's what's driven spreads in the corporate market narrower, because there's been people want that extra yield and the supply is rather limited. A lot of it been hogged off into the private market. So I think that says to me that yield spreads are likely to get narrower, and we're not going to have any big spike in the long end of the curve for foreign institutional investors, and also the Fed being able to control what they would issue to keep that under control.
Yeah, you've really outlined some of the big technical issues that investors need to contend with, whether it's in equities or in fixed income. Margie, always a pleasure. Thank you so much for joining us. Happy holidays and Happy New Year to you. Margie Patel of Allspring Global Investments.
Ryan Petersen of Flexport writing, we're seeing strong demand for ocean freight. It could be driven by a multitude of factors. Fear of a potential IAL strike and tariff increases, earlier than usual Lunar New Year, plus a strong economy. Ryan joins us now. Ryan, really interesting there when you think about this increased demand for ocean freight. You name a number of factors as we just walked through. Is that taking share from other methods, or is this just the pie growing bigger?
Well, I think what you're seeing is a pull forward. So it's taking share from the future, that people are trying to get goods in before a potential strike or tariffs. If you're concerned about those things, which you should be, and you have the option, you have the flexibility in your supply chain, you want to get the goods in as soon as possible to avoid the disruption.
And how much can we draw on the experience of the 2016 election and the first Trump administration when it comes to mapping out the potential impacts of some of the tariffs that we're talking about?
Yeah, I mean, we've seen this movie before in many ways. The tariffs weren't as disruptive as people maybe expected them to be. Their tariffs have existed, throughout all of human history. It's basically how governments always funded themselves. So people are able to adapt to this. It's not huge shock, but it is. The big thing right now is the uncertainty. It's like, what exactly is going to hit? When is it going to hit? How is it going to hit? So, for example, just this week, the president of Mexico actually imposed large tariffs against imports from China. And to everyone's surprise, those actually affected Mexican fulfillment centers. So these are e-commerce warehouses who are not shipping into Mexico, but import to Mexico in order to re-export those goods to consumers in the U.S. That's a huge way that U.S. e-commerce is done, is actually out of fulfillment centers in Mexico. And this morning, late last night, the largest fulfillment centers in Mexico had to email all of their customers and cancel all their contracts. So a lot of American businesses are scrambling today to find new fulfillment opportunities, new ways to serve their customers in the U.S., even though it had nothing to do with the U.S. government.
Yeah, that feels like a complete wild card. So when something like that happens, basically someone throws a deck of cards up in the air, how long does it take for a new normal to be set in place?
The fun part about working in logistics, we all figured out many years ago, there's no such thing as normal, and we got to be ready for whatever happens. So it's every day a new thing. It feels like between the strikes in the Red Sea disrupting ocean freight, you've got tariffs, you've got a drought that's affecting the Panama Canal. It's you just have to be very nimble and agile if you want to run a supply chain in the modern world.
Yeah, makes sense. Going back to the tariffs question that Katie was posing, the details, of course, are TBD. We don't know when, we don't know how much, but we do know that some form of these tariffs are coming on imported goods into the U.S. And the mechanics are pretty clear in terms of tariffs tend to reduce demand for these imports, at least if you're American. But you also point out that we've seen a decrease in ocean freight rates from China, and that could be an offset. So walk us through what that might mean for goods that are being imported from China and how manufacturers think about that.
Yeah, we'll see. Ocean freight rates have been quite high throughout the year, sort of 2 to 3 times long-run historical averages. And this is in a market where the supply side of the market, the number of ships in operation and their capacity, has ballooned. There's been a huge deployment of new container ships that, as these carriers made a lot of money during the last cycle, during COVID, they reinvested that in new ships. So one would predict with this huge surge of supply that the price will come down. The only reason that hasn't happened is because of the Red Sea. It's absorbing capacity as ships have to go around the southern coast of Africa. If anything is to be done and allowing container ships to return through the Red Sea, that will instantly bring the price of ocean freight down by 2/3 or so is our guess, maybe more. probably saving companies $4,000 to $5,000 per container that they import. That's a pretty big deal. The average value of an ocean container at wholesale, the goods inside of it is probably $100,000. So if you're talking about 25% tariffs, that's $25,000. Helps a little bit. It's not going to get you all the way back there, though. The $25,000 per container is a pretty big blow.
Yeah, absolutely. And I mean, as we've been talking about, there's a lot of unknown here. And it's both about the levels that we're talking about, the final levels, whether or not we get deals negotiated with our trade partners. But when it comes to actual tariffs, in your notes, you write that there's basically only two ways that businesses can deal with new tariffs. They can absorb the cost themselves, or they can increase their prices. And the businesses that you work with, that you speak to, what are you hearing so far about which path they're actually going to follow?
Yeah, well, that's a very simplistic way to try to simplify things for everybody. I think that's true in the very short run. If you've got goods on the water coming here and not much else to do but pay the tariffs, and then you have to choose whether to make less money or pass it on. But in the medium term, there's a lot of strategies available. You can, by the way, make goods in the United States and you don't have to pay any tariffs. You may on the raw materials, but you won't on the finished goods, which is most of the value. You can make goods in other countries that have free trade agreements with the United States. There's tariff engineering. So by understanding at a very detailed level, partnering with your customs broker like us here at Flexport, you can understand the raw materials and how those create the duty rate. And if you change things, you may get a different duty rate. So there's a lot of opportunity to reduce tariffs over the medium term. And I think companies are getting really smart about this. Thanks to the last cycle, all of these strategies have been deployed. If you didn't see this coming at all, sure, people weren't sure that Trump was going to get elected. But by the way, Biden's been increasing tariffs too. So I think people have been preparing for this for a while and should be in a reasonably okay place to adapt to it.
Well, Ryan, where are we on the nearshoring/onshoring narrative? Because that's been a big push over the last couple of years, especially gaining steam in the pandemic. But you know better than most people that supply chains are pretty slow-moving animals. They take a long time to actually shift and move them. So where are we on that push?
It really depends on the sector. I mean, there's a massive amount of real industrialization taking place in the United States right now, but it tends to be much higher value goods, higher complexity things that and the deployment of things like advanced manufacturing and robotics. But for low value goods, what you're seeing is that the shift down to countries like Vietnam, to Mexico as well, but even cheaper countries like Vietnam and Cambodia. India is having quite a boom right now in exports. So it's and then certain things, China is still just a great country at manufacturing, and there are certain sectors where even with higher tariffs, it still makes economic sense to produce there because of the quality and the scale of their manufacturing capabilities. And you see it. I was in China not too long ago, and the quality of their cars is remarkable. That even with high tariffs, I think for much of the world, people are going to still want to import those cars. They're so much cheaper and better than what's produced domestically in most countries.
Yeah, and at affordable prices, no less, too. Ryan, as you speak with your customers, what is the number one worry that they have for 2025 beyond tariffs? Because that is a big unknown, and it kind of hangs over everything.
Yeah, I mean, short term, it's definitely this ILA, the strike on the East Coast that's looming over our heads. We had that back in October for 4 or 5 days, and then the Biden administration stepped in and kind of told them, hey, knock it off before the election. So they got to stay until January 15th, an extension of the contract. Well, that's 5 days before inauguration, obviously. So we are very much in crunch time for what happens with those negotiations. My latest understanding was that the two parties weren't even speaking to each other to get it, so the odds of a deal seemed kind of low. The demands of the union right now is not just no more automation and higher wages. They've already achieved those. The carriers and the employers have agreed to that, but they're asking for reverse automation, actually eliminate automation that already exists.
All right, Ryan, great to speak with you and get your insight. That is Ryan Petersen of Flexport. We have Stuart Kaiser of Citi writing, our preferred vehicles would be large cap tech quality, and growth, given the higher for longer nature of the SEP forecast. Looking further ahead, payrolls on January 10th are a major catalyst, given last month's data, the SEP update, and markets pricing just 2 cuts in 2025 and a 10% chance of a 25 basis point cut in January. I'm pleased to say that Stuart joins us in studio right now. It's great to see you in person.
Morning.
So I want to talk about higher for longer trades. We're back to talking about that after Powell's performance last week. Is that the right conversation to be having going into 2025?
It's the right conversation if you believe the Fed. I think if you're worried about risk reward, then you're probably worried about, the unemployment rate kind of rising a little bit. So, I mean, the Fed kind of guided you towards the unemployment rate's going to flatten out. Inflation is stickier than we would like, but it's going to come down, and they're going to do a couple insurance cuts next year. That actually sounds a whole lot like the front half of 2024 when large cap tech and growth did really well. So I think that the Fed's prescription would be to be in those stocks. The risk to that, I think the market is kind of questioning a little bit this idea that the unemployment rate is going to be as friendly as that is.
Well, you write in your notes that the SEP, of course, the dot plot as well, was equity positive at its core. And that stuck out to me because the market reaction was not positive. So walk us through that a little bit more, that fewer rate cuts in 2025 may be actually good news for risk assets.
Yeah, I think ultimately the market will come back to that view. I think what happened last week is the market had coalesced around the idea that we had a strong growth environment. What the Fed did is it kind of sprinkled in or added in a little bit of additional CPI risk. And I think the market traded that negatively last year, was that the Fed seemed to be a little bit concerned about the pace, with which CPI was coming down. He also went into that print with a very, very strong, equity momentum, very, very long positioning and things of that nature. So I think what you really got is the core of the statement and the core of the SEP, et cetera, was positive, but you added on the new information was not super friendly, and that ran into strong positioning, and you kind of got a little bit of a pullback. Our view on rate cuts is pretty simple, is if you're pricing out cuts because growth is strong, that's good for equities. If you're pricing out growth because of inflation, fiscal, and deficit risks, that's going to be negative. So maybe the market interpreted that last week on the negative side of the ledger.
Well, whatever the catalyst is for yields moving higher, if yields on the 10-year get to 5% or maybe even 6%, how do you expect that to impact equities?
I think, yields getting to 5%, you could come up with a good reason why the 10-year yield could get to 5%. And that reason would likely be, tax cuts, deregulation, and a positive growth impulse. I mean, if you're talking a 6% handle, it's hard for me to see the 10-year getting to 6 for quote unquote good reasons. So again, I think if you go from 4.60 to 5% and that's coming from a good place, I think equity markets are fine with that. We're a little bit more concerned, as Katie mentioned earlier, with the really long end of the curve, because it's very hard to come up with a positive story why the 30-year yield would, let's say, get to 6%. So I think it's that bond term premium and it's the long end of the yield curve that I think is probably the bigger risk from a rates perspective. But again, I think it's the why that matters, and we're going to kind of stick to that at least for now.
In terms of the market's move, it's been a fairly placid move up for 2024, at least in aggregate. Talk a little bit about volatility, because you point out that implied volatility has gone from cheap to rich in just 1 week. What was behind that, and what does that signal in terms of where we stand versus other asset classes? Yeah,
look, I think U.S. equity markets, because of the rally, because of the relatively sanguine view on the Fed coming in, you had U.S. equity volatility come down substantially. When the Fed kind of surprised, to Katie's point, a little bit to the negative side, what you got is that impulse kind of reversed itself. We do think that that's going to kind of calm down. It's very hard to keep U.S. equity implied volatility at elevated levels when realized vol is low and when the market's, kind of rallying the way it is. I think the really interesting thing in volatility these days is the correlation between the volatilities is broken down. So there's just been a lot more kind of idiosyncratic risk out there, whether that's, policy headlines in Brazil, what's going on in Korea, what's going on in China, European elections, U.S. elections. So really what you're getting is volatility is kind of a little bit all over the place. And our sort of recommendation there is, if you're using volatility to hedge your portfolio, hedge at home. Don't try to get creative and say, I'm going to hedge U.S. equity risk with some China volatility. No, that stuff just isn't working right now, and I think you just need to be pretty conservative about how you approach that at the moment.
Yeah, it's been interesting, of course, to see the VIX a little bit more elevated than the MOVE index. Haven't seen that too often over the past year. I want to keep going, though, on this relationship between the bond market and the equity market, because it feels like the Magnificent Seven can handle anything except NVIDIA missing earnings expectations, of course. But when it comes to other areas of the market, when it comes to the small caps in particular, that's an area that it feels like you really need rates to come down. Do you agree with that?
Yeah, I mean, if you look what happened last week, I think small cap underperformed the S&P by about 300 basis points. So, that smaller cap, lower quality, sort of higher credit risk stock is going to be much more sensitive to the move in yields. And look, high yield spreads also rose about 20 basis points last week. So I think small cap kind of suffered from both higher yields as well as kind of wider credit spreads. So, yeah, there are pockets of the market that are going to be much more sensitive to that. The Mag 7, large cap tech, most of those are negative net debt stocks anyway. The level of yields and refinance risk is not really applicable to Microsoft. So I think, look, our view on small cap has been it's just a very tricky trade really for the last 6 months, because for that trade to work, you need a soft landing narrative to kind of play out. Higher for longer is a headwind because of higher yields. If the economy slows meaningfully, then that negative growth impulse is horrible for small cap. So small cap, you're really kind of threading a needle here. You need kind of a soft landing growth narrative and a broadening out of earnings.
I'm glad you brought up that when it comes to the big tech stocks, the Magnificent Seven, that their net debt extremely low. And this isn't new, but it feels like that subverts the textbook explanation of you see higher yields and you see tech stocks, you see growth stocks kind of go out the window because of course, that longer duration debt. It just feels like this market, you can't really apply that old logic.
Well, I think you can apply the logic. You just can't apply it to the Mag 7. I think your SMID tech stocks who have that longer duration, yes, I think the rates can really negatively impact them. If you're looking at large cap tech, these are negative net debt, huge free cash flow, paid dividends, buyback stock. So you're not really as reliant on that long-term earnings forecast as you used to be. I'd argue the duration of the Mag 7 is actually much shorter today than it was in the past. So they are a little bit less rate sensitive. If you go into that SMID area of the tech space, then yeah, I think there is still a lot of rate sensitivity there.
How are you thinking about the strong dollar and what it means for U.S. companies and their ability to rely on overseas markets, especially with President-elect Trump intent on imposing tariffs on incoming goods in order for us to be able to sell more goods to those countries? Certainly, a strong U.S. dollar says one thing about our energy companies versus some of our consumer companies. Yeah,
I mean, the strong dollar has been kind of a tricky one, because is the strong dollar strong because of U.S. exceptionalism, which I like, or is the strong dollar strong because of some of the tariff and other risks? So, our view on the dollar is you generally need a pretty big move, and you need that move to be fairly sustainable for it to really start to get into U.S. equities.
7% move in 2024 is pretty sizable.
Yeah, it is. And I think if you look at, if you broke down foreign versus domestic revenue stocks within the U.S., you have seen that trade actually perform, quite well since the election. So I'm not sure it's going to impact the S&P at the sort of top level, but if you get below the surface and you really kind of isolate the stocks that are either from a supply chain perspective or a revenue perspective more exposed to it, you are seeing that because you have seen a pretty big move, but that move has not been sort of large enough to disrupt kind of, I think, index level performance at this point.
We've really seen healthcare companies come under pressure now because of policy concerns, specifically anyone with a pharmacy benefits manager kind of in the bullseye of President-elect Trump. How are you thinking about this sector? Because there was so much excitement about its ability to leverage technology going forward, and of course the fundamental growth story behind healthcare expenses. But that kind of changes now with the policy angle that a Health and Human Services Secretary, RFK Jr. would bring.
Yeah, look, I agree. Coming into the election, our view is banks is the clean trade. Both healthcare and energy are sort of much more nuanced from a sector perspective. And, I think the logic there, and today is that, fine, if, let's say the Democrats win, you get broad-based, healthcare spending, that may be positive for parts of the sector, but they also, let's say, want to negotiate drug prices. And now you're seeing from a Trump election win that you also are getting some mixed signals here where, yes, he may be positive for M&A, maybe that's good for biotech, but maybe he's a headwind for the pharmacy benefit managers or kind of the larger cap healthcare sectors. So we're seeing a lot of people hide out in medical technology. To your point, that is still sort of an active theme. But the sector itself, I would say, is a little bit discombobulated. And we're seeing a very similar thing on the energy side of things. So I think those two sectors in particular, they're very complex sectors, and different, sort of GICS level 2 kind of industry groups are being impacted much, much differently by the election outcome.
All right, Stuart, we have to leave it there. It's great to see you. Happy holidays.
Thank you, too.
To you. That is Stuart Kaiser of Citi.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.